Types of disability insurance. There are two types of disability policies: short-term disability and long-term disability. Short-term policies have a waiting period of 0 to 14 days with a maximum benefit period of no longer than 2 years. Long-term policies have a waiting several months with a maximum benefit period ranging from a few years to a lifetime. Disability policies have two different protection features. Protection feature: non-cancelable and guaranteed renewable. Non-cancelable means that the policy cannot be cancelled by the insurance company except for non-payment for premiums. This gives the policyholder the rights to renew the policy every year without an increase in the premium or a reduction in benefits. Guaranteed renewable gives the policyholder the right to renew the policy with the same benefits and not have the policy cancelled by the company. However, the insurer has the right to increase premiums as long as it does so for all other policyholders in same rating class. There are several options and factors to consider when purchasing a disability policy. Point number one: additional purchase option. The insurance company gives the policyholder the right to buy additional insurance at a later time. Point number two: coordination of benefits. The amount of benefits policyholder receive from their insurance companies is dependent on other benefits they receive because of the disability. The policy specifies a target amount the policyholder will receive from all the policy combined and will make up the difference not paid by other policies. Point number three: cost of living adjustment. The COLA increases disability benefits over time based on the increased cost of living measured by the Consumer Price Index. Policyholders will pay a higher premium if they select the COLA. Point number four: residual or partial disability rider. This provision allows workers to return to work part-time, collection part of their salaries and receiving a partial disability payment if they are still partially disabled. Point number five: return of premium. This provision requires the insurance company to refund part of the premium if no claim are made of for a specific period of time declared in the policy. Point number six: waiver of premium provision. This clause means that the policyholder does not have to pay premium on the policy after he or she is disabled for 90 days. Factors affecting the choice of a disability policy. Point number one: definition of disability. Some policies pay benefits if workers are unable to perform the customary duties of their own occupation. Others pay only if workers are unable to perform any jobs suitable for their level of education and experience. Some policies define disability in terms of workers' occupation for an initial period of 2 or 3 years and then continue to pay benefit only if they are unable to perform any occupation. On occupation policies are more desirable but more expensive. Point number two, benefit period. The benefit period is the amount of time policyholder will receive monthly benefit during their lifetime. Experts usually recommended that the policy pay benefits until at least age 65, at which point Social Security disability will take over. Young people may consider buying a policy offering lifetime benefits because it will still be relatively inexpensive. Point number three, replacement percentage. A policy that will replace from 60% to 70% of total taxable earnings is advisable. A higher replacement percentage, if available, is more expensive. Other sources of income should be evaluated before deciding how much disability coverage is needed. Point number four, coverage for disability resulting from either accidental injury or illness. An accident only policy is less expensive but does not provide adequate protection. Ideally, both accident and illness coverage should be purchased. Point number five, a cost of living increase in benefits. Policies may not pay benefits for all decades or more and should keep pace with increases in the cost of living. Some companies also offer indexed benefits keeping pace with inflation after benefits payment begin. Point number six, a policy a policy paying residual or partial benefits. This type of policy is available so that people can work part-time and still receive a benefit, making up for lost income. A standard feature in some policies and added by a rider to others are residual benefits. Policy pays partial benefits based on loss of income without an initial period of total disability. Point number seven, transition benefits. Offered by some companies, it can offset financial loss during a post-disability period of rebuilding a business or professional practice. Ongoing coverage. A non-cancelable policy will continue in force as long as the premiums are paid. Neither the benefit nor the premium can change. A guaranteed renewable policy keeps the same benefits but may cost more over time since the insurer can increase the premium if it is increased for an entire class of policyholder. And number nine, financial stability. Check the financial stability of insurance through an agent or a trading firms. Topics. These topics are adopted from paper regularly. Captives and other risk financing options. Traditionally, business and other organizations have handled risk by transferring it to an insurance company through the purchase of an insurance policy or alternatively by retaining the risk and allocating funds to meet expected losses through an arrangement known as self-insurance, in which firms retain rather than transfer risk. During the liability critics of the 1980s, when business had trouble obtaining some types of commercial insurance coverage, new mechanisms for transferring risk develops facilities by passage of the product liability risk Retention Act of 1981, the so-called Alternative Risk Transfer (ART) arrangement blend risk transfer and risk retention mechanism and together with self-insurance from the alternative market.